My name is Carly Reddig, and I'm the president-elect for next year's Econ Society. On behalf of the Econ Society, I'd like to thank you guys for coming out tonight. The Econ Society is a student organization dedicated to educating students about economics through putting on lectures and discussions. We're actually trying out new marketing techniques next year. We're trying to improve on our marketing. So if you guys could fill out a survey, it's back on the FFF table at the end of the lecture, and let us know how you guys found out about the event. That'd be awesome. We're honored to have Dr. White speak with us tonight, and we'd like to thank the FFF for making that possible. And without further ado, please welcome Bart Frazier from the FFF.
Well, this is our last lecture of the spring here, and this spring's been a really interesting one. The lectures have been really different this time. In February, we had David Bernstein talking about the Lochner case and constitutional law and constitutional history, and then in March we had Tom Palmer from the Atlas Foundation using his great experience and travel throughout the world and visiting with other liberty-oriented foundations to talk about what are the preconditions for a free society. And we're again going to make another turn here tonight and talk about monetary policy. So we've had a bunch of different lectures, and I think it's probably been one of our best semesters here, so it's been a lot of fun. Thought I'd talk to you guys a little bit about FFF. I'm sure most of you are probably familiar with the Future Freedom Foundation, but for those of you who are new to us, and those of you watching on the internet tonight, we're a nonprofit libertarian education foundation whose mission is to spread an uncompromising vision of individual liberty. And we do it in venues like this and with groups like the GMU Econ Society. We also have a printed journal, Freedom Daily, which we've been publishing since 1990. You can get free samples of it in the back there. And we also have a internet newsletter, FFF Email Update, which is free for the asking. If you just want to send an email to fff@fff.org with subscribe in the subject line, we'll sign you right up. And you'd also get updates as to all of our upcoming events for lectures such as this and other events that we put on. I'd also like to thank the GMU Econ Society, and in particular Leah. Tonight is her last lecture here. She's done a great job of helping to organize this, so big hand for Leah. Congratulations. Going on to bigger and better things. But if you're a potential student listening in tonight, when you arrive at GMU, or if you're here tonight and you're not a member of the Econ Society, please join. It's a great group of students, extremely motivated, extremely bright, and probably cannot join a better organization on campus. We're pleased this evening to have Professor Lawrence H. White. He's GMU's own professor of economics here at George Mason University. Dr. White earned his PhD from the University of California, Los Angeles, and his AB from Harvard University. Previously, he was F.A. Hayek Professor of Economic History in the Department of Economics at the University of Missouri, St. Louis. He has been a visiting professor at the Queen's School of Management and Economics, Queen's University of Belfast, and a visiting scholar at the Federal Reserve Bank of Atlanta. He's the author of 3 books: The Theory of Monetary Institutions, Free Banking in Britain, and Competition in Currency. His talk this evening is entitled The Threat to Sound Money and the Free Banking Solution. Please welcome Lawrence H. White.
Thank you, Bart. I dressed up just so I'd have a pocket to carry my talk in. Okay, my title is The Threat to Sound Money and the Free Banking Solution. I gave a talk, I believe it was in this room a year ago, on what is sound money, and I'm going to try not to repeat that. So instead of discuss all the different meanings that the term has had, I'll just declare that what I mean by sound money is basically money that behaves the way people who hold money want it to behave. So it's kind of a, consumer sovereignty notion. And I presume that means a money that reliably holds its purchasing power over time. We could also define a sound monetary system as a monetary system that's not prone to disturbances from its own constitution, that isn't on shaky foundations. Well, the money we have today, of course, is the fiat US dollar. And although it's not as bad as the Zimbabwe dollar yet, it's far from being as reliable as our money could be. So when I talk about the threat to sound money, don't be a wise guy and say we already don't have sound money. I'm talking about the set of forces that endanger whatever remains of the reliability of the US dollar. And as I see it, there are two main threats to sound money in the United States today. One is the Federal Reserve System, and the second is the rest of the federal government. Now let me go into a little more detail about what I mean. The Federal Reserve System, because of its recent monetary policies and really unprecedented financial market interventions in the last couple of years that have really swollen the Fed's balance sheet and expanded the Fed's role in the financial system. I'll say more about that. And then by the rest of the US government, I mean the Congress and the executive branches through their budgetary policies, the budgetary policies that continue to swell the federal debt. And I'll talk about the connection between debt and the threat to sound money. I do want to borrow one thing from what I said last year, which is to quote the great economist Ludwig von Mises, who reminded us that the concept of sound money is really an ideological concept. It was, to quote him, devised as an instrument against despotic inroads on the part of governments. Ideologically, it belongs in the same class with bills of rights. Right? So by threat to sound money, I mean the same thing that Mises meant by despotic inroads. Policies that threaten to further weaken our money, in particular to covertly repudiate part of the US government's debts and to effectively confiscate our savings by creating too much money, diluting the purchasing power of the money we've got. So let me first talk about what the Fed's been up to, then let me talk about the fiscal problems the US has, then I'll talk about what I see as the ideal monetary system to replace all that. So 3 years ago, at the end of March 2008, the total of the Fed's monetary liabilities, which are known as the monetary base, and they're kind of the foundation on which checking accounts and currency rest, the monetary base was $839 billion. And it had been growing over the previous couple of decades by about 6% a year. 1 year after that, 2 years ago, the monetary base had gone from $839 billion to $1.7 trillion, so it had more than doubled in a single year. That was unprecedented. And that was the opening phase of what became known as QE1, quantitative easing 1. 1 year ago, it was up to $2 trillion, up another 18% over the previous year. That's the rest of QE1. Today, it's $2.46 trillion, so that's a 23% jump over last year. That's the first installment of QE2, and more is promised. So we can look forward to that. All right, so the size of the monetary base has now nearly tripled. What was QE1 about? Well, QE1 was about the Federal Reserve deciding to spend about $1.25 trillion overpaying for mortgage-backed securities. And why would they want to do that? In order to benefit the shareholders and the creditors of failed financial institutions. Take the bad assets off their books, replace them with cash, more than they could get for those securities in the market. So without a vote from Congress, the Fed decided to spend $1.25 trillion of government funds playing favorites in financial markets. Congress didn't need to appropriate the funds, isn't that wonderful? Because the Fed could simply create the money as new claims upon itself. That's the power the Federal Reserve has. Now, there are many questions you might ask about QE1. For example, isn't it inflationary to triple the monetary base? And normally, yes, doubling or tripling the monetary base is inflationary. But there was a second part to QE1, which is what happened on the other side of the Fed's balance sheet. While it was acquiring these assets and creating, on the other side of its balance sheet, it was creating bank reserves to pay for them. Right? Those are the money created with the stroke of a pen. But the Fed was paying the banking system, and it still is, paying the banking system to hold those reserves and not lend them out. Sterilize them is the technical term. Hold them as excess reserves, not lend them out. How did it do that? By paying interest on them. For the first time, the Fed began paying interest on bank reserves. So it's not a coincidence these two things happened at the same time. Paying interest on reserves was necessary to keep the broader money supply from also doubling or tripling as a result of the monetary base doubling and tripling. And in a way, this means that QE1 was not really monetary policy. It was not intended to increase the money supply dramatically. The paying interest on reserves, in fact, was designed to keep that from happening. It was really a fiscal policy operation. The Fed was borrowing from the banking system and using that to finance its purchases of these troubled assets. Now, I said that's pretty unprecedented. Was it legal, you might ask? Well, if you actually read the Federal Reserve Act, there's a section called 13.3, which is fairly elastic in giving the Fed broad authority to buy just about anything it wants in an emergency. But it doesn't say the Fed can double its balance sheet with this kind of stuff. It's supposed to be emergency, not carrying on for 2-3 years. And it's supposed to be the exception. It's not supposed to be the bulk of the Fed's balance sheet. There are also some rules about what kind of assets the Fed is supposed to acquire, and mortgage-backed securities, not clear whether they qualify. But anyway, it's clearly not within the spirit of traditional central bank functioning. And so, even more than before, the Fed has abandoned the rule of law and adopted the rule of central bankers. You might ask about QE1, well, but was it a good idea? Did it have better consequences than the alternative? I don't think so. I think this decision to save everybody in the financial system, with the exception of Lehman Brothers and a few smaller banks, of which QE1 was a part, TARP was another part, I think that whole package explains why we're having a slow recovery and is in danger of keeping our growth of the economy slow for many years to come. Another question you might ask, why would the Fed do something that would be good for certain financial interests, but not good for the economy as a whole? And at that point, I would say, you really haven't been paying attention, have you? Funny you should ask. It turns out that this sort of thing is entirely in character for the Fed. And this is the point at which I plug my current working paper, which is available on the Cato Institute website, entitled Has the Fed Been a Failure?, co-authored with George Selgin and Bill Lestraps. And we look at the Fed's history and ask, over the last, 1914 to the 97 years, has the Fed been a failure? That is, has it accomplished what it set out to do, or what its founders thought that it should do? And our answer is that it has been a failure. It's failed even in its own terms. It hasn't achieved its own stated objectives. I mean, never mind the constitutional objections, never mind the political economy. Under the Fed's tenure, recessions have not been less frequent, they haven't been shorter, they haven't been less severe. Now, how can I say that? Weren't there lots of financial panics before the Federal Reserve Act, and haven't those gone away? No, they haven't gone away. We just had one. And in the 1930s, we had several. Of course, the recent one was the worst since the Great Depression, but the Great Depression happened under the Fed's watch, and the financial panics that were part of the Great Depression, the banking panics, were part of the Fed's record. If you look at the worst year of the Great Depression, here's a tidbit for you economic history buffs. If you look at the worst year of the Great Depression in terms of bank failures, the overall rate measured by percentage of deposits in failed banks was slightly less than 8%. In 2008, the same measure was 16%. If you count the unofficially insolvent Bank of America, Citibank, and Wachovia. Of course, those aren't officially counted because they were never resolved, despite being insolvent. So that's twice as bad. Of course, the defense of QE1 and the defense of TARP was that they were going to help us avoid an even worse financial meltdown. I don't think so. I don't think they did. I think they mostly just redistributed losses, moved them on to taxpayers and away from shareholders and creditors of large financial institutions. And I think they very much worsened the problem of moral hazard by widening the scope of the doctrine of too big to fail. Right? Saving everybody is going to make the next financial crisis that much worse. Well, let's go back to the Fed's history and link it up to the question of sound money. The Fed controls the quantity of money in the economy. That gives it control over the purchasing power of the dollar, so that's a matter of supply and demand. The Fed has notoriously failed to preserve the purchasing power of the dollar. Right? Before the Federal Reserve silver and gold standards kept the dollar's value roughly constant over decades. On the Fed's watch, as you probably heard, since 1914, the dollar has lost 95% of its purchasing power. So a dollar today only buys as much as a nickel bought in 1914. One defense of the Fed is that, well, but under the gold standard, the price level still moved around a bit. Yeah, it's true, it moved around a bit, but not as much as it's been moving around since the Fed. And here's one way to think about whether the purchasing power of the dollar is steadier today than it was in the 19th century. Let's look at the market in which people trade dollars today for claims to dollars in the future, namely the bond market, and ask, how long a bond are people willing to buy? Under the gold standard, people were willing to buy 50-year railroad bonds, 100-year bonds even in some cases. That market has disappeared, right? Corporations don't try to issue bonds of that length. The number of 30-year corporate bonds has gone down, right? So people who actually have to put their money on whether they can estimate the future purchasing power of the dollar 20 or 30 or 40 years out are less confident. Now, one thing the Fed's defenders sometimes credit it with is at least preventing deflation. Right? Under the gold standard, we had years of deflation, and we've avoided those since the Great Depression, haven't we? Well, look, we need to recognize a distinction between two kinds of deflation, and this is a distinction that Chairman Bernanke simply seems unwilling to recognize. There's a distinction between benign deflation and harmful deflation. Not all deflation is harmful. Right? When productivity increases, when goods become cheaper to produce, it's a good thing that their prices are allowed to fall. That's signaling something to people in the marketplace. That's the good kind of deflation. The bad kind is if the reason prices fall is that people are hoarding money or the Fed is shrinking the money supply. Now, before the Federal Reserve Act, deflation was mostly good. The Fed has wiped out episodes of good deflation, but there have been several episodes of bad deflation, even under the Fed's watch. 1920, 1930, and there were 2 quarters of deflation in 2008, 2009. Okay, so we gave up stable money, we gave up a stable purchasing power for the dollar, but didn't we get greater stability of real output? No. Real output hasn't been more stable or less variable under the Fed. Clearly that's obvious if we include the Great Depression. But suppose we put that aside and say, okay, that was just practice. We'll spot the Fed the Great Depression. Has the real output been more stable since World War II? Well, it used to be reasonable to think so because the statistics seem to say so. But economists in recent decades have gone back through the statistics and said, you know, we're comparing apples and oranges here because the series we have pre-World War I are not as broadly based. There aren't as many commodities being tracked. In fact, it's much narrower. So you get more variation just from the fact that you got a smaller number of data series that you're averaging. One of the economists who did this, by the way, was Christina Romer, back when she was a respectable academic. But she and others made improvements to our measures of real output in the earlier years. And with these improved measures, it's pretty much a wash, but actually the pre-Fed period looks a little bit more stable than the post-World War II period. So the Fed can't claim to have improved economic stability, even if we disregard the Great Depression, which is spotting them a pretty big one. And this despite the fact that the economy is a lot less agricultural than it used to be. It's a lot better diversified. It's a lot more service-oriented. And it includes more government spending. Not that that's a good thing, but at least it's chronically steady. So you would expect improved stability in the economy even if the Fed did nothing. But our way of reading the data suggests the Fed has done worse than nothing. It's had a more stable economy to deal with. In sophisticated measures of supply shocks, there are fewer that the Fed has had to contend with than there were in the period before the Federal Reserve Act. And yet the economy hasn't been any more stable. Okay, so where are we today with the Fed? We've had these massive bailouts. In my view, they did not save the economy. They've sharply increased bad incentives, moral hazard. We have a monetary base of $2.5 trillion. When at a normal growth rate over the last 3 years, we would have had about $1 trillion. So we've got 2.5 times the monetary base that we should have. And what does that imply? That implies that if banks start lending out their excess reserves, broader measures of the money supply, M1 and M2, will start growing. And if the ratio of those measures to the monetary base, if banks return to their normal reserve ratios, instead of holding these massive excess reserves, we'll have a 150% increase in the stock of money. Now, you remember your quantity theory of money. You know that that implies a 150% increase in the price level. So we've got all the makings for a 150% increase in the price level. That would be bad. Okay? So the Fed needs an exit strategy. It doesn't have one. All it has said, all that Bernanke has said is, well, if the reserves start leaking out, then we'll start raising the interest rate we're paying banks to hold the reserves. And we'll raise the rate as necessary. But not clear how high that's going to become. Right? Interest rates are not going to stay less than 1% forever. Inflation's going to start picking up. Interest rates are going to start rising. And to keep those reserves in the bank when they could be lending them out at higher and higher interest rates is going to take a higher and higher interest rate on bank reserves. It's not clear how high the Fed is prepared to go. They haven't said. So we've got this big overhang of reserves, no real exit strategy for withdrawing it from the market. Everybody thought that when recovery began, the Fed would let it dry up as the mortgage-backed securities began to mature. It hasn't happened. They've announced QE2, which is basically saying we're going to leave all that in the economy and add a little bit more. So that's creating a great amount of regime uncertainty in the financial system, and that's a threat to sound money and a sound monetary system. Okay, now I want to talk about the fiscal threat. I was at the Cato Monetary Conference in November, and one of the speakers on the same panel I was on, in fact, was an economist named George Tavlis from the Bank of Greece, note Greece. And his opening line was, "It's a pleasure to be in the United States again, which more than ever feels like being at home." Right? As we all know, a sovereign debt crisis hit Greece in the fall of 2009. And what does that mean? It means the budget deficit was running 13% of GDP. The accumulated debt had risen to 113% of GDP. Greek government bonds fell to junk bond status. The market yield on 2-year Greek government bonds rose to 12.26%. Right? And this is in a non-inflationary currency. This is in the euro, or low inflation currency, I should say. So that's a huge interest rate. Same thing happened to Ireland a year later, fall of 2010. Yields on 10-year Irish bonds reached 8.2%. When you reach interest rates like that, when the government is rolling over its debt, and one estimate was that Greece had to roll over a third of its debt every year, at an interest rate which is way above the economy's growth rate, the debt is just going to keep growing as a percent of GDP. It's a mathematical certainty. Right? The economy is growing at 3%, and you're paying 12% more each time you roll over your debt, you have a problem. You got a trap you can't get out of unless you start running surpluses. And there's no sign of that happening. Or somebody comes and pays all the debt for you. And of course, that debate is happening in Europe right now. And some of the countries, like Germany, say, are dragging their heels a bit, as I would hope they would do if I were a German taxpayer. So how does this relate to the US? Well, Greece had 13% deficits. We have 10% deficits. Greece had 113% of GDP debt. We're getting there. We're in the high 60s and rising, and estimates are we may hit 100% by 10 years from now. Depends on how optimistic your scenario is. But actually, if you look at the Congressional Budget Office projections, it turns out their optimistic scenario is one in which taxes rise by enough to keep up with all the new entitlement spending. The pessimistic scenario is where taxes don't rise, so the deficit grows, but spending is on the same path. So which do you want? Do you want huge government debt, or do you want huge current taxes? Neither one is a very optimistic scenario. And a lot of that spending is pre-programmed, right? It's entitlement spending. So we've got a problem coming up in the US. It's not here now. Bond yields are still low, but we're running record peacetime deficits, 10% this year, 9% last year, 10% the year before that. At that rate, well, the debt to GDP ratio grows by 10% a year. So if you start at 60%, in 4 years you're at 100%. One thing that's probably more important to compare the federal government's borrowing to than GDP is private saving, because that's the pool of savings available to be lent. Federal borrowing is now taking up more than half, 50 to 60% of private savings. Right? So those are savings that could otherwise go to capital formation. Right? So there's a connection between high debt and low economic growth. The debt crowds out government debt crowds out private capital formation. And so I've said we're above 60% now. It's the first time we've been above 50% since the Second World War. And that's just the tip of the official iceberg. If you add in state and local debt, and if you add in Fannie Mae and Freddie Mac, which are de facto full faith and credit debts now, that raises us to about 150% of GDP. And I'm not even talking about entitlements yet. Here the estimates vary, but if you add in the unfunded portion of Social Security, Medicare, Medicaid, the Pension Guarantee Plan, and so on, we're running somewhere around 800% of GDP, at least according to one estimate. So that's not a rosy scenario. When debt gets that high, there's a recent study by Reinhardt and Rogoff showing that when a country gets above 90%, that's when growth begins clearly to slow down. Before 90%, there doesn't seem to be a very strong relation, but countries that get above 90% see their growth slow down. And I mentioned that the US government's borrowing rate hasn't risen yet, but what happened in Greece and Ireland could happen in the US. The credit rating of the Treasury could go down. Moody's has been warning that it's preparing to issue a negative report, which is the first step before it downgrades the bond status. And that means T-bill rates rise. If the market loses confidence, they could rise a lot. They could rise above the growth rate of the economy. Then we're in the same trap that Greece and Ireland are in. So what does this debt trap have to do with sound money? Well, the government has the power to inflate away its debt, and it becomes very tempting to do that when debt is high, and governments have done that since ancient times. Go read The Wealth of Nations. Adam Smith talks about how ancient governments commonly, when their rulers were burdened with debt, resorted to debasing the coin, right? Reducing the metallic content of the unit of account. Well, we've already reduced that to zero, but we can still reduce the purchasing power of the dollar by printing more of them. Now, we could, but would the US do something like that? We already have. If you look at the last time we were heavily indebted, which was leaving World War II, the federal debt was then about 130% of GDP. By 1970, it had fallen to 40%. That sounds good, except that the price level doubled. So that did about half the job. That raises GDP measured in dollars, not in real terms, but measured in dollars. That lowers the ratio, but it's not something you want to see if you're a debt holder. Not if you've got treasury bonds in your pension fund, you don't want to see that. So creditors saw half of the real value of their treasury bonds inflated away. Right, so the Federal Reserve has the power to create monetary expansion, which creates inflation, which erodes the real value of the debt held by the public. Well, but they don't have to do that, do they? Why can't they just keep borrowing? Well, when you get into a debt trap, you can't just keep borrowing. You eventually hit a ceiling where you can't borrow anymore because, in real terms, that is, as the interest rate rises, you get to the point where borrowing another bit of money raises the interest rate a little bit more, and that higher interest rate gets applied to the entire previous debt because you have to roll it over every so often. So that means the net proceeds of borrowing is nothing. You've got some more money, but you have to use it to pay higher interest on all your old debt. So there's a ceiling. It's kind of a Laffer curve of debt finance to how much real revenue can be gotten by borrowing. And at that point, the only thing left is printing money to pay the government's bills. That's the typical story of a hyperinflation. Right? So you don't want to go down that road. When you go down that road, the inflation can't be stopped because the money printing can't be stopped until there's a fiscal reform, until there's something done to change the size of the debt and the deficits. Here's another way to put it. If you run a deficit, you have to have a combination of either debt finance or inflationary finance, that is, money printing finance. And when you run out of borrowing, when you run out of bond finance, then you're left with monetary finance. So how do we avoid this kind of fate? Something has to be done to tie the hands of the monetary authority. Some economists in the 80s who talked about this problem, which they called unpleasant monetarist arithmetic, one of them being Thomas Sargent, suggested that, well, you could have the central bank announce its plans for money growth first, and then the fiscal authorities have to adjust to it. Yeah, but it doesn't work that way when the Fed has no constitutional constraint, and the Federal Reserve Act was enacted by the same people who are creating the deficits. So if they want to go first, they get to go first under our current regime. A better way, I'm going to suggest, is to switch from a fiat monetary regime where the central bank can print money to a commodity money regime where nobody can print money in the same way. Nobody can print basic money. Banks can issue money, but they're constrained by the need to redeem it in the commodity money. And Sargent actually made this suggestion recently in an interview, which is encouraging to me. Here's what he said. Under the gold standard, there was no law that restricted your debt to GDP ratio. Feasibility and credit markets did the job. If a country wanted to be on a gold standard, it had to balance its budget in a present value sense. That is, you could borrow, but you had to be committed to paying back the borrowing in the future. If you didn't run a balanced budget in the present value sense, you were going to have a run on your currency sooner or later, and probably sooner. So what induced Western countries to run more or less balanced budgets in the 19th and early 20th centuries before World War I was their decision to adhere to the gold standard. I think that argument has gotten more and more relevant as we become closer and closer, and will become more relevant as we get closer and closer to falling into one of these debt traps. Now, Sargent kind of assumed that when he talks about a run on your currency, that you have a central bank, and they're the only issuers of dollars, and they're the only holders of gold reserves. So they're the ones who are going to feel the pain of a speculative attack. But actually, a lot of countries before World War I, and in fact the ones with the more credible commitment to the gold standard, were the ones that didn't even have a central bank. The US didn't have a central bank. Canada didn't have a central bank. Australia, New Zealand, it's actually a fairly long list. Instead, they had private, decentralized issue of money by commercial banks. And a commercial bank can't just suspend payments. It's bound by contract law. Right? So that seems to me to be a more reliable constraint than Congress passing a rule that says the Fed isn't going to print more money until Congress passes a rule telling them to print more money. I'm not saying we should go back to exactly the system the United States had before the Federal Reserve Act. There were panics. It was far from the best available system because it was pretty far from a free financial market, a free banking system. There were regulations that weakened the banks, and that's what set the stage for panics. So there was a genuine problem. I think the way to have gone would have been to deregulate and eliminate the obstacles to banks handling the problem. Instead, we got a Federal Reserve Act. It was the progressive era. But after the panic of 1907, the first thing Congress did was to convene a commission to talk about it, the National Monetary Commission. And they concluded, rightly I think, that the system was broken, something needed to be done. Unfortunately, instead of trying deregulation, they tried a central bank. But we just had a big financial panic, the panic of 2007. We have just as much reason as people did in 1910 to conclude that our system is broken. Something needs to be done to improve it. Hopefully this time around, right, we'll learn from our failed experiment with the Federal Reserve System, and we'll try something else. And what I'm recommending is sound money through free banking. And by free banking, I mean banking without artificial restrictions, without privileges, without bailouts, without too big to fail, money regulated by free market forces instead of regulated by a central bank. So let me now talk about that in a little bit more detail. There are kind of two parts to the program. You can look at it one way or the other. You can look at the negative side, which is we're trying to come up with a way of obstructing government's propensity to meddle with our money. Right? And the best way to do it is take the creation of money out of the government's hands entirely. The positive side is we're affirming that the market can provide us with a high-quality money, just as it provides us with high-quality shoes and computers. Right? We had generally affirmed that market mechanisms are the best in producing private goods and services. Why not money? Well, but isn't money special? Isn't money different from these other goods? In my book that Bart mentioned, The Theory of Monetary Institutions, I actually have a whole chapter devoted to critically analyzing the argument that money is somehow a public good. It's not an ordinary private good. And basically, the argument for money being a public good is an empty box. There's nothing there. If you look at history, there's no market failure to produce sound money. Competitive market processes have produced sound money, can produce it, will produce it if they're allowed to. Initially, right, governments didn't invent money. Markets created the first monies. Markets converged on commodity money standards. And there's a survival of the fittest whereby the most suitable commodities became selected as the monetary standards. And then with increasing financial sophistication, private mints, private banks produced reputable coins, produced currency notes, produced checking accounts. The late economist Hans Sennholz summarized the situation pretty well, I think, when he wrote that today sound money and free banking are not impossible, they are merely illegal, unquote. Let me say more about the banking system, free banking, and then let me say something about the commodity standard. So free banking is just a phrase for laissez-faire banking. There were banking reform laws, this is a footnote, passed in various states of the U.S. in the 1830s, 40s, and 50s, which were labeled free banking laws, but they weren't laissez-faire. They were regulatory systems. They were given the name free banking as a kind of selling point. I wish that still worked today. They were not systems legally unrestricted by government. They had particular sets of restrictions. Now notice I say, I've been saying without legal restrictions, that's what I'm suggesting. I don't like to say without regulation, because to call what government does regulation is to imply that it makes things more regular. But it doesn't do that. It merely restricts the market. Now, there are market mechanisms that I would call regulation. The New York Stock Exchange regulates trading on the New York Stock Exchange. They actually do make it more regular. But that's who we need to leave the rulemaking to. The organized exchanges, the organized bank clearinghouses, those are the institutions that have an incentive to get it right. So the argument for laissez-faire banking, kind of in a nutshell, one, there isn't any good theoretical case showing why government ought to restrict money issued by banks or subsidize it for that matter. The leading arguments for market failure don't hold any water. Secondly, if you look at historical evidence, the least restricted, the closest examples we've got to free banking systems have worked the best. They were more stable than the more regulated systems of the time. They provided sound money. They weren't perfect, nor were they complete laissez-faire, but they were closer to laissez-faire and they were sounder than the more restricted systems. So in my first book that Bart mentioned, Free Banking in Britain, I look at the Scottish system before 1844. And if we had more time, I could tell you lots of hilarious stories about those wacky Scottish bankers, because they were really crazy. No, actually not. Actually, they were quite sober, and they were so good that they sent bankers around the world. A lot of banking systems around the world were founded by Scottish bankers who were sort of the leading practitioners of the day, and they gained the practice in a competitive system. They weren't, they were in demand because their system worked. Point three, government restrictions and monopoly, both in theory, if you got the right theory, and practice, bring us problems. They make money unsound. I think the historical record's pretty clear on that. And point four, it would be possible and it would be desirable to reestablish provision of money by free market banks. Okay, if the Fed's not on the scene, if there's no central bank, what replaces monetary policy? Who decides, or what decides how much money there is in the economy? Well, ordinary kinds of money, checking accounts, hand-to-hand currency, would be issued, again, by commercial banks. And by the way, there are still a few places in the world where paper money is issued by private commercial banks. Scotland still has private note issue. I wouldn't call it free banking anymore. It's down to 3 banks because of legal restrictions. Northern Ireland, Bart mentioned that I spent time teaching at Queen's University in Belfast. Northern Ireland has 4 banks of issue still, 4 private banks. So you go to the ATM of the Northern Bank, it spits out Northern banknotes to you. It's quite charming. And it's much safer to visit there than it was when I was teaching there. And Hong Kong still has a private note issue. So that would be the sort of ordinary money people use day to day, but something is behind it. Something is in reserve. That bank-issued money is redeemable for something that banks do not create, namely some kind of commodity money. And when you have that kind of system, there's no need for a central bank. Now, here are the words of one expert. See if you can guess who said this. You didn't need a central bank when we were on the gold standard, which was back in the 19th century. All the automatic things occurred because people would buy and sell gold, and the market would do what the Fed does now. Any guesses? Alan Greenspan, on The Daily Show while plugging his book in 2007. And what I want to know is, who wrote the question that Stewart asked, which was, if you believe in the free market, how can you think we need a central bank? Because that's government. That's government setting interest rates. How is that consistent with having a free market? And Greenspan said, well, that's a good question. And Stewart said, well, should I withdraw it then? He said, no, and then he answered what I just told you. And he conceded that if you have a central bank, you don't have a free market. But Greenspan's defense was, if you have a gold standard, you don't need a central bank, but we no longer have a gold standard, so we need a central bank to control the quantity of money. So if you have a monetary system where the central bank can issue as much money as it wants, you need a central bank to control the central bank. That seemed to be the gist of his answer. That doesn't seem to me like an argument for having a central bank. It seems to me like an argument for having a gold standard. So Greenspan is conceding, roundaboutly, that the U.S. did not need a central bank at the time the Federal Reserve Act was passed, because we had a gold standard at that time. But of course, fiat money has replaced the gold standard now. So we need to consider the question again of whether this kind of unbacked paper money standard is better than a commodity standard. And I think the view that it's better is based on two things. One, among economists, one, an overestimate of how costly in terms of resources a commodity standard is. And the main source of that, unfortunately, is Milton Friedman. Milton Friedman came up with this very high estimate of the resource cost of a commodity standard. But if you look into it, which almost nobody does, I see this estimate cited time and again, but people don't realize what it depends on. Friedman's estimate, which was 2.5% of GDP every year, that's a lot. It was based on assuming that M2, mind you, which includes time deposits mostly, is going to be 100% backed in gold. Even the believers in 100% reserve gold standard don't believe in M2 being backed 100%. Right? So this is a huge overestimate of how much gold you need to have. If you put in a reasonable reserve ratio, you get a figure that's about 1/50th of Friedman's figure, right? Not 2.5% of GDP, but 0.05 of 1% of GDP. And that is pretty small compared to estimates of the deadweight cost of inflation. If you look at the difference in inflation between the fiat standard we've had and the gold standard we've had in the US, the difference is much bigger than the break-even point at which the fiat standard saves you the resource costs of having a gold standard. Right? The deadweight cost of inflation, which is the most conservative way to estimate the cost of inflation, gives you a much bigger figure than 0.05 of 1% of GDP. But the other reason I think that many economists defend a fiat standard is they engage in wishful thinking about the wonderful benefits of managing the economy through managing the supply of money. That's the Keynesian argument. Right? So it's supposed to be a way to stabilize macroeconomic conditions. Smooth out interest rates, smooth out output fluctuations, smooth out unemployment. How's that going? It's supposed to be a way to try to do those things, but it hasn't worked out so well in practice. And I mentioned earlier the paper I'm working on with Selgin and Lestrapes. Success of the central bank is below the break-even rate. And that's in the US. And our central bank is not as bad as many. Like I said, it's not as bad as Zimbabwe yet. To stabilize the economy, the Fed would have to know more than anybody can know. So it's not that the wrong people are in charge, it's that they've been given an impossible task. But in practice, as I said, they've made inflation higher, they've distorted interest rates and made business cycles worse by fueling unsustainable booms, and consequently they've made recessions deeper than they need to be. What I like about a commodity standard? Well, it removes the issue of basic money from the government's hands, and therefore from the temptation to inflate away the debt and to use printing money to redistribute wealth in favor of the government's favored beneficiaries. Right? Fiat money is produced at, we used to say at the stroke of a pen, now we say what, the click of a mouse. That's prone to expansion in a way that gold and silver, which have to be dug out of the ground, are not. Gold and silver are apolitical and they're global. You can have an international monetary standard. Of course, the world used to have an international monetary standard without any country being in charge. Some people in recent years have started to talk about this ideal again. Wouldn't it be nice to have an international monetary standard? But who do we put in charge? The IMF? Some committee of leading central banks? None of those give us much reason for optimism. Now, it's always possible, and this is part of the Keynesian argument, it's always possible to, and actually part of Friedman's argument too, because what he wanted to substitute for a commodity standard, which he admitted at least controlled inflation, was a way of controlling inflation without the gold by controlling money growth. And so he had a formula for doing that. It's always going to be possible on a blackboard or a whiteboard or a PowerPoint to design a system which looks like it's going to be more stable and cheaper than a commodity money system. We just don't have any experience with any such thing actually working. It's like some philosopher said, in theory there's no difference between theory and practice, but in practice there is. Now we could talk about why a gold and silver standard, or silver standard, why not some other commodity, why not some bundle of commodities which might be more stable. Maybe we should save that to Q&A. My feeling is we've already got a large stock of gold in Fort Knox, assuming it's still there. Why not let the public use it? Another thing we might want to talk about in Q&A is whether we should allow banks to have fractional reserves or 100% reserves. My view is whichever you want, whatever kind of contract you want to make is okay with me. I wouldn't ban 100% reserve institutions. I don't expect them to be very popular. They weren't popular historically. I wouldn't ban fractional reserve banks because I believe in freedom of contract. Would anybody who is well informed agree to a fractional reserve banking contract? Yeah, because they get a better deal. They don't have to pay storage fees, like 1% a year. They don't have to pay transfer fees whenever they want to write a check. And they can have paper money. Without fractional reserve banking, it's simply infeasible to have circulating paper money. How can you charge storage fees if you don't even know who's got the note? How are you going to track them down and charge storage fees to them? The whole beauty of circulating banknotes is that the bank doesn't need to know whose pocket they're in. But if it's going to try to charge storage fees, and it has to recoup its storage costs, it has to know who's got it. So I've looked, I can't find any historical examples of circulating 100% warehouse receipts, although some advocates of 100% reserve banking have a fantasy that such things are possible. Oh, here's another tidbit. I discovered that the phrase that Keynes used to describe the gold standard, he called it a barbarous relic. That phrase was actually used earlier by Edwin Cannon, who was in favor of the gold standard, to describe proposals to eliminate banknotes so that everybody had to carry around pockets full of huge coins. He said that's a relic of barbarism. Keynes twisted the phrase later on. As a bonus, a system of fractional reserve banking economizes on the quantity of gold it takes. I referred to my estimate earlier that it economizes on the resource costs. Adam Smith emphasized this point in The Wealth of Nations. He said it's the fact that we've substituted bank-issued money for gold that's allowed Scotland to get rich. It's allowed us to export our gold and convert it into machines and make the economy richer. And Mises, who I mentioned earlier, basically agreed with Smith. He wrote, quote, "Fiduciary media," that was his name for banknotes, "tap a lucrative source of revenue for their issuer. They enrich both the person that issues them and the community that employs them." Okay. The leading mainstream argument, putting fractional reserve banking debate to one side, the leading mainstream argument against fractional reserve free banking is the belief that unrestricted banks are going to be prone to collapse, that there will be epidemics of bank runs. I deal with that argument in Chapter 6 of A Theory of Monetary Institutions, but let me just cite some historical evidence for doubting it. One, runs were not a problem in all banking systems. They were a problem in the US, yes, but not in Canada, not in Scotland, not in Sweden. They're not inherent to fractional reserve banking. There was something different about the US, namely that we weakened the banks through perverse regulation. Secondly, the leading theory that makes runs happen at any time is a kind of sunspot theory or bubble theory. People run just because they're afraid of other people running. That doesn't explain when runs happened historically. In fact, people ran if they had good reason to think a bank was insolvent. But before deposit insurance, banks had reasons to avoid being insolvent and to advertise credibly that they were not insolvent. And there were very few runs on solvent banks. In fact, during the recent financial crisis, there was a run on Bear Stearns. Bear Stearns was insolvent. There was a run on Lehman Brothers. Lehman was insolvent. And when a bank is insolvent, that's a good thing. that pulls the plug. It keeps it from wasting even more resources. It's not a tragedy that you close an insolvent financial institution, and a bank run does that for you. So there are good runs and bad runs. Okay, so fractional reserve banks are not inherently fragile, but we've created deposit guarantees as though they were, and that's had very real costs. It's made our banking system more fragile, ironically, because banks have taken advantage of the incentives. In the debate over federal deposit insurance in the 1930s, the large banks were actually against it. Why? Because they were perceived as safe, and as there were runs on small banks, people moved their money into the larger, sounder banks. Nowadays, they would be the loudest arguing against it if anybody proposed to phase out deposit insurance, because they have adapted, right? As I mentioned before, Bank of America and Citibank, by all reports, were technically insolvent, but it was not recognized. So I like free banking. I like a gold standard. I think they're mutually reinforcing. The gold standard makes a central bank unnecessary, makes free banking feasible. Running a gold standard without a central bank makes it stronger, makes it more credible, makes it sounder, in a word. All right, so if we want a gold standard more durable than the 19th century gold standard, let's not create another central bank. Let me end with some amazingly prescient words from William Graham Sumner, who wrote an essay in the 1890s about people's proposals to reform the monetary system by creating some federal institution. It was entitled Playing into the Hands of the Money Sharks. So he said that's what these reformers are doing if they think that creating a government agency to restrict the financial system is going to benefit them. It's not. They're playing into the hands of the money sharks. And I think this is worth keeping in mind when we read that the Dodd-Frank bill was over 2,000 pages, and we're still discovering stuff that was hidden inside of it. So here's what Sumner said. We hear fierce denunciations of what is called the money power. It's spoken of as mighty, demoniacal, dangerous, and schemes are proposed for mastering it, schemes which are futile and ridiculous if it is what it is said to be. Every one of these schemes only opens chances for the money jobbers and financial wreckers to operate upon brokerages and differences while making legitimate finance hazardous and expensive, thereby adding to the cost of commercial operations. The parasites on the industrial system flourish whenever the system is complicated. Confusion, disorder, irregularity, uncertainty are the conditions of their growth. The surest means to kill them is to make the currency absolutely simple and absolutely sound. Is it not childish for honest people to set up a currency system which is full of subtleties and mysteries, and then to suppose that they, and not the men of craft and guile, will get the profits of it? Thank you very much.
All right, we're going to do Q&A now. So I will bring the mic to you if you raise your hand. Please wait for the mic to ask a question. On another note, the mic is just for the camera, so speak loudly. Okay?
I was wondering if you had an opinion on Bitcoin. Russ Roberts recently did a podcast on it, and I was wondering if that would be an alternative to free banking.
I don't have a very well-informed opinion on Bitcoin, but right, so it's some kind of online currency. I'm not quite sure how you earn it. I'm not sure where you spend it. But let me say this generally about efforts to launch new currencies. I'm all in favor of them, but there's a real critical mass problem in launching a new currency. Everybody expects to get or wants to get paid in the stuff that's easiest to spend, and for the time being that means the monetary standard we're currently on. So it's hard to get a critical mass going for something else. Now, I don't want to overstate it. We do see spontaneous switches in monetary standard in countries where the incumbent currency gets really bad. So in countries with really high inflation, in pesos, people switch to dollars, right? Even sometimes when it's illegal. So you can have a switch in the kind of money people use. But I hope we can have monetary reform without having a hyperinflation first. Having these kind of alternatives available will help, I think, and having silver and gold alternatives legal. You may have heard about some of the legal problems that people trying to push gold and silver systems have had recently. I think that having more options would help, but I don't think that's an alternative to monetary reform. I think we need to do something with this system that's the incumbent system now.
I'm sorry if this is too specific, but you touched on the CBO's projections for accumulated debt over time, and when I was checking them out last summer, it had like the most pessimistic estimate was that we would hit 120% of GDP within 25 years, and the other ones were really much rosier. But could you explain how they come up with those estimates?
Baseline scenario, what they call, the CBO calls it, assumes that we can take Congress at its word, so that's very naive. In particular, at the time they were projecting that you looked at, they assumed that the Bush tax cuts would expire, so taxes would go up. They assumed that Obamacare would fund itself, okay, and stuff like that. The alternative scenario is, let's assume that the tax cuts don't expire, and let's assume that Obamacare costs a certain amount. And then the more pessimistic is, let's just assume that the government continues to spend what it's currently spending, which is 25% of GDP. And let's assume that tax revenue continues to be what it has been for the last decade, more or less, which is 19% of GDP. So you got a 6% deficit every year. And then you get the figures I talked about.
Hello. Given that there is no free banking and there is a central bank, and that people's demand to hold money increases or decreases, shouldn't the central bank print money or take money out of circulation to react to those changes in demand? And isn't that what QE1 and QE2 kind of are? Like a clumsy mimicry of a free banking system.
Okay, good question. To the first part, should the central bank try to accommodate changes in the public's demand to hold money? I think the answer is ideally yes, if they could do so in a timely fashion. I'm not too optimistic about their doing a good job of it. They haven't done a good job of it in the past. If you look at the Fed's track record, if they were offsetting changes in the demand for money, or changes in velocity is another way to put it, then you would see the money supply expanding at a time when the economy was slowing down, but actually, you would see it be uncorrelated with the behavior of nominal GDP. They would be stabilizing GDP. In fact, the evidence shows that when they're expanding the money supply, they're causing GDP to go off track. And when the money supply is shrinking, it's going off track in the other direction. So their track record is not very good. But in principle, yes. In principle, yes. It would be better to satisfy the demand for money than to put the economy through a racking deflation. Second part of your question was, isn't that what QE1 was about? And the answer to that, I used to think that there was a defense of QE1 along those lines. After all, we did have negative GDP growth, both nominal and real, and we did have falling prices. But that's not what QE1 was about, I've come to decide. I mean, I've come to think about it differently. I mean, it was pointed out to me that you can't just look at half of it, which is the Fed expanding its balance sheet. You also have to look at the Fed paying interest on reserves and thereby increasing the demand for money, increasing the demand to hold base money. So they caused the problem. They're the ones that sort of set the fire that they came in with QE1 to put out, or came in with the asset purchases and said, see, we're putting out the fire. But that was a fire that they set. Or really, the whole thing was not designed to satisfy a demand for money which had already risen. It created a demand for bank reserves by paying interest on them, and then used that to finance the purchasing of assets. So that's my view of what QE1 was. If they had wanted to just meet a demand to hold money, all they had to do was buy Treasury bills. Right? And if they had just bought Treasury bills, then it would have been a very different operation. They don't need to buy mortgage-backed securities.
Yes, I was reading in the Wall Street Journal that that the dollar is losing its uh, status as a world reserve currency because people don't have confidence in it anymore as a crisis. First, is that true? And if that's true, what would that mean in real terms? Would that be the hyperinflation scenario that some people talk about?
It's to some extent true. There are some countries that actually peg their own currencies to the US dollar, and they literally hold dollars as reserves. And the most important of those is China. China is a big holder of dollar-denominated securities. Right? They don't actually hold Federal Reserve notes in vaults. They hold interest-bearing assets. And China has been making noises and actually appears to have rearranged its portfolio a bit, such that they're not so exclusively pegged to the dollar, but to a more diversified basket of currencies. So how does that affect the dollar? Well, it reduces the value of the dollar in foreign exchange markets if foreigners are demanding fewer dollars. All right, so that can be sort of the opening act of a move to higher inflation. Imports start going up in price because the dollar is weak in foreign exchange markets. You have to pay more dollars to buy imports. The other thing that's been happening is that as the dollar becomes less reliable as a pricing unit, because its purchasing power is no longer so steady, you see some commodities that used to be priced only in dollars now being priced in other currencies. That itself doesn't change the demand to hold dollars, but it may be a kind of, canary in the coal mine that people are concerned about the reliability of the dollar. Something that will sort of indicate to us that the purchasing power of the dollar is no longer trusted overseas is when the demand for treasury bills of anything but the very shortest term begins to dry up. So there are currently kind of mixed signals. The exchange value of the dollar is falling, and the price of gold and silver is skyrocketing. And those suggest some people are expecting higher inflation. But interest rates on long-term treasuries haven't risen all that much. And if you look at the yields paid on inflation-indexed bonds, those haven't gone up very much. So those are signals suggesting that at least investors in those markets aren't expecting high inflation yet. So the outlook's kind of mixed. I had the privilege of appearing on the Judge Napolitano show, Freedom Watch, a couple of months ago, and in the green room I met Peter Schiff, who's well known as a financial prognosticator, and he's predicting higher inflation. I said, so does that mean I should invest in inflation-indexed bonds? I asked naively. And he said, I never recommend those. Why not? The government sets the index.
Before the question, can I have you please repeat his question? Over the internet.
Okay.
Thank you.
Yes, I wanted to ask you about the point you made about the cost of having a gold standard and Friedman's estimate. I didn't quite understand. What is it that causes the cost? Is it mining additional gold or silver to make coins? And if so, why can't there just be a one-time cost? Why is it always necessary to keep increasing the money? Why can't we just leave a set amount of money out there, and you'll have what you call favorable deflation, I guess, as the productivity increases? So it seems to me that maybe it's only a one-time cost, pretty much, and maybe replacement of coins that get bad. So why does it have to be such a big cost?
Okay, so the question is, what explains the estimate of the resource cost of a gold standard being so high? Why do you need to keep mining more gold? Why can't you just start with a certain amount of gold and leave it there? Why do you have to keep importing more gold? Well, Friedman's assumption, and I think it's a reasonable assumption, given the way an international gold standard works, is that the gold mines are going to continue to operate, and gold's going to flow into your country as your economy grows. Right? As your economy grows, the demand to hold money in your economy grows. And that's going to lead to an increase in the demand for money. And under the assumption that all forms of money are backed 100% by gold, in order for people to hold more money, more gold is going to flow in. And you would say, well, wait a minute, why can't the purchasing power of money go up and that satisfy the demand instead of more gold being imported? And the answer is, if you're on an international standard, you can't have a different purchasing power of gold than the rest of the world. So this is happening all over the world. And his assumption was that the mining cost is pretty much constant. So that means the purchasing power of gold over time remains constant. But as the economy grows and as demand to hold money for transaction grows, that means more and more gold needs to be held. So that was his argument. Right? And I'm saying if you admit that there are fractional reserves, if you allow that there are fractional reserves, then you can have more and more money being held with only a little bit more gold each year. And so the resource costs are much smaller.
I think I come under the heading of a wacky Scotsman, but this allows me to ask the question probably. I like the idea of commodity money, but do you think there's any chance that the 500 odd politicians in DC would ever make that sort of proposal?
Okay, the question was, is there any chance that Congress will go back to a commodity money standard? Not in this Congress. Although I think the number of gold standard supporters has gone from 1 to 2, so that's a 100% increase. But yes, it will take a few more election cycles before Congress is prepared to do that, and it'll take pressure from the voting public. And it may be that it doesn't happen until the fiat system has gotten much worse, or has crashed, you might say. Now, a reason to be optimistic is that if you look around the world, there are countries that have reformed their monetary systems by switching to a sounder, what they regard as a sounder money than they were using before, and adopting an external standard, one that they don't themselves control. And so proposing that the US should go back on a gold standard is like that. And what I have in mind are Latin American countries that have dollarized. Okay, when I go to Latin America, I say that give your citizens that option, that's better for them. And if you do that, I'll go back and try to keep the dollar from exploding. But some countries, after a hyperinflation, they officially dollarized. But El Salvador decided to adopt the dollar while inflation was still under 10% because they wanted to lock it in. They knew they couldn't restrain their central bank for very much longer. They said, let's switch while we can. So that's a case in which a country didn't have to go through a hyperinflation in order to decide to adopt something that they themselves couldn't inflate away.
Hi, thank you for speaking. Realistically, what would the transition to a free banking and or gold standard look like? And do you see any problems like strong deflationary problems associated with that? Thanks.
Okay, the question is, what would the transition look like? This is a big question. What I think is an important, I don't have a plan that covers every contingency, but what I think of as the important issue in returning to a gold standard, say, is to pick a conversion rate for the US dollar which would enable us to avoid either a big inflation, a massive inflation in the transition, or a massive deflation. So I would like to avoid either of those. This is kind of tricky. It's sometimes called the re-entry problem. You have to try to estimate how much gold would be demanded under the new regime where inflation is going to be lower and therefore money demand is going to be somewhat higher than in our current system. Although we're at a pretty low inflation rate right now, so this is actually the best time to do it. We could basically just pick the market price of gold. I did a calculation once asking if there is all the gold in Fort Knox that there's supposed to be, what reserve ratio would it provide against M1, evaluated at the market price? And back then, when gold was only around 1,000 an ounce, the answer was about 8% reserves. Now that gold is higher than that, of course the monetary base is a lot higher too. But M1 hasn't grown all that much. I think the answer is something like 10% currently. I should do the calculation again. But that's more than enough. All right, so my proposal would be to establish the option to convert your dollars back into gold if you wanted to. But if we set it at the market price, then there's no profit to be had from doing that. I mean, some people have proposed, you know what we ought to do? We ought to back the M1 100%. And to do that with the gold in Fort Knox, let's see, we just need a price of $6,000 an ounce. Yeah, but if you set the price of gold at $6,000 an ounce, the economy's going to have to go through a racking deflation to get there. I'm sorry, the other way around. That's a high price. It's going to have to go through a big inflation to get there. Basically, what's going to happen is if an ounce of gold buys $6,000 worth of goods in the U.S., but only buys $1,400 worth of goods elsewhere in the world, gold is going to come flowing into the U.S. in a massive way. And that means we're going to be giving up goods to get gold in a massive way. It would actually be a very expensive proposition. So if you convert at the market price, and the market price is not far off of what the demand for money will be once we're on a gold standard, then we could do it without any major hiccups. But I guess I would advise, study the way countries have gone back to the gold standard after suspending the gold standard, and see how they did it without major upsets. The U.S. after the Civil War is an example where the gold standard was resumed through many years of very gradual deflation because they decided to go back to the old parity. I don't think we need to do that because we don't need to go back to the old parity. We don't need to go back to $35 an ounce. Right? That would be silly. Take it from where we are. We can avoid the need to go through any kind of protracted process. Now, freeing up the banking system, that may be even more intricate. I mean, that's even more like trying to defuse a bomb and making sure you clip the wires in the right order. You couldn't abolish deposit insurance tomorrow, this is Monday, without there being bank runs on Wednesday, right? Because we've got insolvent banks. Let's be frank about it. So we need to reestablish soundness in the banking system. And how exactly to do that consistent with peeling back the guarantees. I mean, the first thing is to eliminate too big to fail in a credible way, and then sort of scale back deposit insurance as far as we can. And so uninsured depositors will, the more uninsured depositors they are, the more incentive banks have to behave safely. I didn't mention this, but a good piece of evidence for that is if you look at offshore banks, they don't have deposit insurance. They haven't had runs. They didn't have a financial crisis. Why? Because they're not managed like banks with deposit insurance. They actually have a pretty well maturity matched portfolio. They don't borrow short and lend 30 years. They borrow short and they lend short. They're pretty well matched. They don't take a lot of currency risk. They don't take a lot of default risk. They're well diversified and they have higher capital ratios than banks onshore. So we need to get our domestic banks back toward that model. And then we can start peeling away the guarantees and subsidies as well as the restrictions.
Your observation that they're trying to avoid an inflation more than a deflation, not predicting so much what's going to happen, but more what they are looking out for. It seems that they're trying to avoid a deflation, from what I've heard. From what Bernanke, I think, has said.
So the question is, does Bernanke have a sort of asymmetric bias when it comes to avoiding inflation and deflation? Yeah, I think he has a bias against deflation, even the good kind of deflation. As I said, he doesn't recognize that there is such a thing as good deflation. And People who are inside the Fed tell me that when Greenspan blew up the housing bubble because by keeping interest rates so low for so long in 2002, 3, 4, 5, it was Bernanke whispering in his ear saying, we're going to have deflation if you don't do this. And so, and if you read what he's written, it's pretty clear he's much more worried about deflation than inflation. So he's erring on the side of inflation.
I'm sorry, I meant to say. Not deflation.
Oh, well, unfortunately, once the Fed has created a big inflationary boom, it doesn't have the power to avoid the depression that follows, or recession, to use the polite term. And so, despite what you might regard as the Fed's best efforts, we still just had a very severe recession, 2007 to 9.
Some of us think the private sector still matters, and you were talking about the change in allowing for the paying of interest on bank reserves, but there was no change for the private sector for corporations to hold their reserves, and yet we've seen a huge increase in the amount that the private sector is holding and not reinvesting. Can you explain the disparity there? I mean, that the Fed is paying interest on bank reserves wouldn't explain why the private sector is holding an increasing amount of theirs.
Okay, so the question is, even if interest on reserves explains why banks aren't lending, why are corporations retaining their earnings rather than investing them? Because they're not getting that payment. Well, the banks have to think about the interest they're earning on reserves, which is pretty close to zero, and the return they would earn from lending it out, which in the absence of what they regard as creditworthy borrowers is pretty close to zero, and the interest rate on treasury debt in the short term is pretty close to zero. So they're willing not to lend under those conditions. Corporations, I have to guess, I have to infer, aren't very optimistic about the prospects for investment. And as the economy recovers, they should become more optimistic, but there is reason for them to be concerned about what kind of regime we're going to live in the next few years. We've got this huge debt, which implies higher future taxes, but we don't know what taxes, when, on what. There's been big changes in the regulatory environment. So there's a great deal of regime uncertainty is the kind of buzz phrase for it. And it's similar to the discouragement of investment during the Great Depression. Not quite on that magnitude yet, but it took a long time for investment to revive when the rules were changing every day. I don't know if that's a full explanation, but that's, I think, one of the factors at work, an important factor at work.
Hi, I think you mentioned you're against the QE1 and QE2s, and I'm just wondering if you can briefly describe what our situation will be without QE1 and QE2, because I think all the major financial institutions are heavily interconnected, and if one fail, it will cause many others fail. So how will we recover from the financial crisis if there weren't QE1 and QE2s? Thank you.
Okay, so the question is, if we didn't have QE1 and QE2, wouldn't we have a collapse in the financial system? I think in a situation where financial institutions have made very bad decisions, there needs to be a resolution, and keeping them afloat doesn't really provide the resolution. And I think Japan learned the hard way that just stretching the process out for a decade doesn't really do the economy any favors. So if instead of buying $1 trillion in mortgage-backed securities, the Fed had not bought the securities, It could still have satisfied the demand for money to the extent that there was an additional demand for money. It wouldn't have had to pay interest on reserves. But it would have meant that it would have had to close insolvent institutions, which I think it ought to do. But the institutions that were not insolvent would then be in an environment that was healthier going forward. So the last thing you want to do is create what during the savings and loan fiasco were known as zombie institutions. Right? If you've seen Night of the Living Dead, you know what trouble you get when you allow dead corpses to roam the streets feeding on the innocent. And that's kind of what zombie financial institutions do. They make it more difficult even for healthy institutions to survive. They bid up interest rates on deposits. They bid down interest rates on loans. And so they make it more difficult for well-run, prudent financial institutions to survive. And if you look at financial institutions that did everything right, that were very conservative, what was their reward when the crisis hit? Did they get to mop up the mistakes of other people by buying stuff cheaply and buying other institutions cheaply? No. Right? The other institutions were being kept on life support. So yeah, I would bite the bullet. I would resolve the insolvent institutions. Right? If nobody wants to buy them, then you do what we did with finally did after years of delay with the insolvent savings and loans, which is put their assets in a holding tank and liquidate them.
Larry, we have time for one more.
Okay.
Hello, thank you. A question then, isn't this a similar issue or discussion with regards to the euro in terms of Greece and Ireland and so on? In terms of buying the bad bonds and so on?
Yeah, so the question is what's been happening in Europe, and the answer is many of the same issues have come up in Europe. And I mean, one of the most dramatic events is what happened in Ireland, where one of the largest banks failed, and the Irish government decided to inject as much money as it took to keep that bank alive. And that much money was about 30% of GDP, and that meant the budget deficit, it wasn't that much, but it made the budget deficit go from up to about 30% of GDP. And suddenly people said, whoa, I'm not buying Irish bonds. And so now the whole economy, you got a fiscal crisis on top of the banking crisis. Now, no doubt, a lot of people would have felt a lot of pain if that bank had been allowed to go under. The creditors would have been wiped out. But the alternative is to have other people feel the pain, right? The losses have already happened. It's a question of how you distribute them. And it seems to me the right way to distribute them is that the people who took the risk of lending the bank money are the ones who should bear the consequences. But the question of the European Central Bank now, the European Central Bank is sort of insulated from actually injecting money into the financial system the way the Fed did. They give the money to the national central banks, and they decide whether they want to rescue banks or not. But they have a limited budget, right? The Bundesbank cannot print money anymore. And that's, I think, a virtue of the system in Europe. Now, governments that decided to lend to financial institutions are themselves, like Ireland, having fiscal crises now. And the question now on the table is, will the European Central Bank bail out the governments? Will it buy their bonds when nobody else will? And I hope the answer is no, but that's the battle that's being fought, because the European Central Bank was kind of our last big hope that we could write a constitution that committed a central bank to price stability and nothing else and have it work. And now it looks like they're crumbling under pressure. They're willing to give up price stability for the sake of creditors in financial institutions. So thank you very much.